This is TreppWire Week in Review for the week ending October 6, 2023. I'm Haley Keene with Trepp, a data, modeling, and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Hendry, Chief Product Officer. This week, investors who hoped that a change of fortune would come after flipping the calendar from September to October were deeply disappointed. October largely picked up where September left off. Stocks tumbled early this week as Treasury yields continued to surge. The word stagflation began appearing more and more as higher bond yields coincided with disappointing economic data. Notably, the ADP jobs number hit its lowest level since early 2022. Manus, it was another forgettable week for investors. Is there any light at the end of this tunnel?
Well, longtime listeners of the podcast know that I love my classic rock references, so I will butcher an old Who line, meet the new month, same as the old month, right? September was a terrible month for investors across the spectrum. For fixed income investors, we saw higher Treasury yields, which coincide with lower bond prices. We saw spreads widen on risk assets. And of course, we saw stocks really limp throughout the month of September and post their biggest losses of the year. October hasn't been much better. Tuesday, we saw a huge sell-off of stocks that coincided with the 5-year and the 10-year Treasury rate, both hitting 4.8%. Those are 16-year highs on those instruments, and that's not conducive for investors to put risk on. The NASDAQ that day was down nearly 2%, and it continues a pattern that began in late August of a really, really struggling market. And I think you hit the nail on the head with that term stagflation, that we are seeing sharply higher bond yields, sharply higher risk spreads, risk premiums at a time where the economic data is getting worse. We saw the ADP number come out earlier this week. It was less than 100,000 jobs, the lowest number in 20 months, and half of what analysts were expecting. The ISM services PMI number was barely in expansion territory. It was a tick out of moving into contraction territory. All of that says, on the one hand, we're seeing surging yields. On the other hand, we're seeing really weak economic data. That sounds a lot like what we had in the 1970s. And I think that's making people very nervous.
Yeah, I was actually at a conference earlier today, Manus, and the keynote that was given a market update, the word stagflation was used as well. So, we're starting to see that word come up more and more as the data becomes more available. You talked about the ADP jobs report. I think I saw something on Twitter this week that 7 or 8 months in a row that data has been revised and revised significantly. So it's almost unreliable at this point. And then when numbers come in half of what the estimate is, it just makes you question, the veracity of the data, both initially and then even once it's revised. Something else that piqued my interest this week was the New York City rent control discussion. We had talked about this a couple of months ago when Bob Knakal was on, about potential for this being a Supreme Court case under claims that it's unconstitutional and effectively grounds of a taking, and the Supreme Court ruled this week that they're not going to be taking up that case. They declined to take it up. So that falls by the wayside. Probably even more negative news for that Signature Bank portfolio that's still hanging out there. I know we had some inbound email from some people in New York that are more closely aligned with the rent control or rent stabilized portfolio than we are, which we may try to get on the podcast at some point. But just more negative news if you're a multifamily owner in New York that has any type of rent control. Economic news, not great. Stock news, bond news, not great. Not a great start to the month of October, maybe outside of some cooler weather down here in Texas.
I forgot about that. I'm glad you brought it up. The rent control decision by the Fed not to take up the case. I think that there had been optimism in the Wall Street Journal. There had been some opinions out there that this might be a case ripe for the court to take on and to put some limits on what local jurisdictions could do in terms of limiting rent growth and so forth. I think people were kind of counting on it in New York, and it was disappointing to see that not picked up. You and I know, and Haley knows, that we've seen things in New York selling for 70 and 60 and 50% of what they sold for a couple of years ago in the rent controlled and rent stabilized segments. And this certainly won't help that part of the market. We also know that there wasn't really a lot of demand for taking that part of the portfolio over from either Signature Bank or First Republic. So really an ill wind blowing there on the rent controlled side. I will take a turn on this because I don't want to be entirely negative at the open. Certainly, we're disappointed by the weak economic prints. And anytime you're talking about a 5-year, 10-year treasury or a 5% 10-year treasury, which is where we are almost today, that's kind of scary. But for me, I think there's a lot of opportunity right now for those that are willing to dip their toe into risk assets right now. And let me talk about what I mean there. When you are talking about a 5% 10-year treasury, and you're talking about BBB minus CMBS trading at, let's call it 900 over, you're talking about a 14% all-in yield for BBB minus securities. Now, I'm not a financial advisor. I'm probably not even allowed to be saying this, right? I think there's opportunity there. But personally, that's where I've been dipping my toe, buying funds where they trade down the risk assets into CLOs and lower rated BBB minus assets where they can get double digit yields in that 13 or 14% range and maybe higher in some cases. I don't think the world is ending. I think that in some places, the world is ending, if you're talking about San Francisco office, Baltimore office, and other places. But that is a fraction of the commercial real estate market. We are still seeing transactions. We are still seeing trades. We are still seeing small balance loans muddle through, outperform, get paid off at levels significantly higher than the big institutional types of debts. And accordingly, I'm not saying I'm backing up the truck and betting the farm on this, but I do think at a 14% yield, some of these securities out there are quite enticing.
I think this is where I'm supposed to say, Haley, insert the disclaimer music, and please consult the services of a licensed professional to make investment decisions. Past performance is not an indication of future performance.
Absolutely.
Something like that. Yeah.
Yeah, I certainly don't like to give people advice. Everybody has their own risk appetite and so forth, but I'm not shy about telling people what I do. And there are funds out there that traffic in these parts of the market, and they're smart guys, and I don't expect them to blow up. And I like the fact that I can get divvies or returns of somewhere between 12 and 15%. For a guy like me, it's where I should have a fraction of my portfolio. Don't tell my wife.
And Lonnie, there was a piece in the Financial Times today that talked about who feels the pain from the bond sell-off, and it actually quoted some of Trepp's data.
Yeah, so this was a really great article. If you haven't had a chance to read it yet, you should. It was in the Financial Times. Who feels the pain from the bond sell-off? Our own Matt Anderson was quoted in here and provided a lot of the data that led to the article. Sell-off in global bond markets really pushed borrowing costs, highest level in decades or more. This could potentially mean heavy losses for banks, insurers, pension funds, asset managers, all of which own trillions of dollars of sovereign and corporate debt. This is coming on the heels of them loading up on those in recent years. And then paper losses on the most opaque part of the U.S. bank bond portfolios are now close to about $400 billion, which would be an all-time high, and it's above the peak at the start of the year, which caused the collapse of Silicon Valley Bank. That was a quote from our own Matt Anderson. So a couple of other takeaways here. After receiving an avalanche of deposits from venture capital funds, SVB, we've heard the story here. They ramped up their investment, about $120 billion portfolio in highly rated government-backed securities. And then when the rates rose sharply, the portfolio fell significantly, almost equal to what the bank's total capital was, which is what made it vulnerable to the wave of the customers fleeing from their deposits. And so it's a really interesting piece. I think it's very timely given where we are in the cycle and what we've seen transpire.
Yeah, it's a good piece, and it's a good reminder to our audience that we do have reams and reams of data. We could tell you which banks hold these securities. We could tell you which banks hold these loans. To the point we made maybe 3 or 4 months ago, there will be different outcomes for different banks depending on what they own in earnest. We know that back in May, the Fed put in that rule which allowed banks to pledge securities at basically face value instead of mark-to-marketing them in terms of what they're able to borrow against. That immunized a lot of the banks against huge illiquidity problems due to mark-to-marketing CMBS portfolios and RMBS portfolios. If they hold loans, however, illiquid loans, it's a different story. So knowing the bank data is important when you're trying to figure out, who's at risk and who isn't.
So let's turn to our property type segment. We're going to start with retail this week.
Yeah, we had a couple of nice retail stories this week. One of the most underreported parts of retail, I would say, is the number of times outcomes for shopping malls defy both logic and predictions out there. We've heard the term retail apocalypse for the last 5 or 6 years, and there have been some apocalyptic outcomes. We've seen losses of 50, 60, 70%. We can't say that that hasn't happened, but certainly from time to time, you do see very positive outcomes, or at least a muddling through of an outcome for some of these malls that were expected to take losses. And those types of things, because they're not scary headlines, don't always make it to the press. But it is true that some of these things do make their way to the finish line. So without further ado, here are two. The first one comes from a press release from CBL and Horizon Group Properties. We put this out as a trading alert earlier this week. The subject property is the Outlets Shops at Atlanta. This particular property backed a $65 million CMBS loan. That loan made up almost 20% of a 2013 CMBX 7 deal. The collateral was 375,000 square feet of outlet center space in Woodstock, GA. The good news there was that CBL and Horizon Group landed an $80 million loan to refinance the asset. So this particular property, this particular loan will be paid off near term. So that's a really positive story for both bondholders in that CGCMT 2013 deal, as well as for CMBX 7 longs. This one is even better. This one regards the Solano Mall, which is in Fairfield, CA. The story came from both Chain Store Age as well as a press release from Spinoso Real Estate. The story goes that there was a $105 million mall that was part of CMBX 6. The value of the collateral had been cut twice. The value of the collateral had been lowered to below the $105 million outstanding balance on the loan. So there was negative equity there. The loan made up almost 60% of a 2012 CMBS deal. The deal was part of CMBX 6. The loan was slated to mature in July 2022 and had been in CMBS purgatory for 15 months. Now the punchline, Spinoso has come in and acquired the property. As part of that acquisition, they are assuming the mall and are getting a maturity extension for that particular asset. We don't know the length of the extension, but this is a huge green shoot and a huge vote of confidence for the mall market in California. We had talked about Spinoso in the past about how them having success as a receiver, re-tenanting malls that had seen occupancy really dip. This is a case of them again leaning into the mall space, and that makes us very happy. The property is a 560,000 square foot regional mall in Fairfield, CA. The property was built in 81, renovated in 2011. The collateral was valued at $190 million in 2012. Most recently, it was valued at $88 million. So basically, even though there was negative $18 million in equity on this, bondholders and CMBX longs will not see a loss on this particular asset. Great news.
Yes, I wanted to add a little bit here, Manis. We actually got a quote from the founder and CEO of Spinoso. It says, "We're excited about the acquisition of Solano Town Center and see the potential for this asset. Spinoso Real Estate Group acquired Solano Town Center from Starwood Retail Partners, assumed the full mortgage. SREG brought in new equity and extended the mortgage. We see a lot of value in the center have an exciting business plan to evolve this property and are committing new capital in our proprietary best-in-class operating platform to execute our plans. We believe now is the perfect time to invest, and we're working with investors to source additional opportunities. So a really big vote of confidence from Carmen Spinoso, the founder of that group. And it's great to hear that not only are they buying this, they plan on really trying to reposition it. And for those podcast listeners that have been following along for a while, this isn't the first time we've talked about the Spinoso Group. Manus mentioned that we had talked about them earlier. We're actually going to be having their founder and CEO on as a podcast guest here in the next couple of weeks. So more to come on this story, I'm sure, and maybe just what he sees more broadly around the mall space.
And this week, we also saw an article in the Wall Street Journal by our friend Kate King, who talked about how Gucci, Chanel, and other luxury retailers are splurging on American real estate.
I should probably let you handle that, Lonnie. You're much more of a luxury guy than I am. I'm much more of a Dollar General or Walmart or Target type guy. What are your thoughts on that news?
Yeah, it's interesting. I don't know if I'd call myself luxury. I think you and I have been spotted at Kohl's together before. And so if we're calling that luxury, that's the extent of my knowledge. But it is interesting. The premium brands have been expanding in the U.S. I think there's been commentary about them pursuing new markets as their customers are more loyal to in-store shopping. And so a couple of takeaways from the article here were that luxury retailers are really, spending big on their U.S. real estate footprint. And so a couple of examples, Gucci's expanding throughout the U.S., now counts 8 Texas locations and a boutique in downtown Detroit. Chanel recently opened a Beverly Hills flagship after more than doubling its footprint to 30,000 square feet. And if you look at it from just a leasable area or lease signed perspective, luxury retailers have leased about 650,000 square feet of new space in the U.S. over the past 12 months, which is a multiple from the 250,000 square foot they leased last year. And that was according to JLL. So I think, again, I'm a tourist in the luxury goods space, but it seems like they found some staying power here and have really started to expand their footprint across multiple luxury brands.
I gotta say, of all the headlines I saw this week, this one was the one that really stunned me and got my attention more than any other. Because when you see the news across the US, the quality of life issues, the theft, the shrinkage, the looting that we saw in Philadelphia last week, this has really been a real issue for the high-end retailer. So my expectation would have been high-end retailers are tapping the brakes, if not slamming the brakes on new stores until they see a different outcome. And to see this kind of headline, it takes me back to our open, which is it's very easy to get caught up in the negative and the world is ending. And, between the retail stories we started out with and Gucci and other luxury retailers 4Xing their store openings this year versus last year, there's not nearly as much doom and gloom as you would have people believe watching or reading the press around the country, right? There are positive stories out there.
Yeah, I would agree with you, Manus. I think it's just about perspective. We talk a lot about the distress in the market, and we went through the delinquency numbers last episode. And, office delinquency is, skyrocketed over 5%. I mean, by definition, that means 95% of the properties are still performing, And to your point just now, we see the headlines, of course, on the news, they show the looting, they show the other stuff, but those are almost rare instances relative to, the number of consumers that go into stores, make purchases, pay for what they're supposed to, and walk out. And so it is good to have that perspective of understanding what we're seeing on the news is sometimes, most times, every time, depending on your perspective, just an attempt to get more clicks to try to drive more ad sales and other revenue sources. And so I'm in full agreement with you. I would not have expected this based on my perception of where we're at with the luxury retailers, but it's actually a kind of a feel-good story that they've seen enough success or feel there's enough opportunity here for them to grow their footprint so substantially.
Yeah, before I get overwhelmed tonight or tomorrow by people on LinkedIn or Twitter saying I'm way too pie in the sky, I should put this in perspective. And somebody did this for me this week. I wish I could give credit where credit is due, but I can't remember who made this remark, but it so summed up my point of view right now. The person said, and it was a Wall Street analyst or money manager, CMBS and CRE is priced to horrible. Everybody's believing the outcome will be horrible. And his point of view is, if the outcome is just really bad, people will make a lot of money with really bad versus horrible. And I guess that's what I'm saying. I would not be advocating dipping my toe into risk assets with a yield at 6%. I think that would be Pollyanna. What I'm saying is, where these things are getting priced now, they're being priced for disaster, and there will be some disasters, but I think the pricing matches up with the risk you're taking right now so much more than at any time in the last 10 years. That's my point here. So I just want to make sure that people don't think I'm shilling for CMBS. The only people I shill for are my wife and the Giants. And I have to say, it's becoming extraordinarily hard to shill for the Giants these days. If you've watched their last 2 Monday night games, those have been abject disasters. So it's becoming very hard for me to show my face with my Giant hat on these days, but that won't dissuade me. I fan through and through.
And moving on to office, we have a few green shoots to start off with, but then we'll kick it back over to the crabgrass.
The first one comes from the Commercial Observer. Clean energy producer Invenergy has more than doubled its office space at 1 South Wacker in Chicago. Invenergy previously had 75,000 square feet at that property. The property is a 1.2 million square foot office that was renovated in 2020. Invenergy is now adding another 84,000 square feet. It will take their square footage percentage from 6.5% to about 14%. And that's big news because the property backs a $160 million CMBS loan that was packaged into a floating rate transitional loan CMBS in 2020. Occupancy at the property is 61%. DSCR is still under 1.0x. This will give that property a big shot in the arm. And that's a market we don't see a lot of shots in the arm for, that Chicago Loop office market. So good news there for the owners of that property, and good news with Commercial Observer on that reporting. This next one comes from the Washington Business Journal. Metropolitan Square, which is a 650,000 square foot office in DC, has sold for $305 million. The sale equates to about $466 a square foot. The property was acquired by Artemis Real Estate Partners from Blackstone and Boston Properties. The article notes that the building is the 4th largest Class A office in Washington's district neighborhood. Rents at the property average about $80 a square foot. So good news there. In Seattle, where there hasn't been a lot of good news lately, we'll call this a mixed green. Amazon has agreed to extend its lease at Met Park North for 2 years. That news comes from the Puget Sound Business Journal. Why is this mixed green? The good news is that Amazon and Microsoft have given back more than 3 million square feet of space over the last year in that Seattle MSA. So the renewal is a good sign. The bad sign is that Amazon's renewal of that 140,000 square feet is only for 2 years. The firm had a 5-year renewal option. They opted for only 2 years of renewal. So a little bit of mixed green in that one. And lastly, in Washington, D.C., another mixed green. The SEC has extended its lease at the 1.3 million square foot Station Place office, which is near the big train station down in Washington, D.C. This is a little bit of a messy story. The GSA wanted the SEC to move. It had long been thought that they would vacate the 1.3 million square foot Station Place property. They were sued by the developer of that property who was trying to keep them from leaving. The litigation went on long enough that the GSA was forced to extend. They will now stay at that lease another 5 years. And that comes according to both the Washington Business Journal and the Commercial Observer. So that Union Station neighborhood gets the SEC for at least another couple of years.
Yeah, so I'm going to go back to the green shoot that you started with at 1 South Wacker, Manus. It didn't say what the terms were on the lease, and so on that particular property, with the debt service being under 1 and occupancy at 61%, I would have to assume that the tenant there, Invenergy, was able to probably secure that additional square footage at a really great rate. So hopefully for them, they were able to get a below market deal, and hopefully for the owner, they lock them in for a long term, which hopefully helps them kind of reposition that asset. There were 2 other quick stories I wanted to just mention briefly, both from down here in Texas. Houston's office conversion pipeline. So we've talked a lot about office to residential conversion. I know there's a lot of differing opinions on the viability of that, but according to a Real Deal article this week, they said the Houston office conversion pipeline hits 5 million square feet. So 2.3% of the metro's inventory is due for new uses. Houston's been riding a wave of nationwide trend in office conversions. And so, it's really kind of been thought of as a trendsetter relative to this concept. And the city was ranked 4th in the nation for conversions. This was according to a CBRE report, which I think is interesting because, Houston has really positioned itself with government incentives and other local government support, which is really acting as a catalyst for some of these conversions. This is kind of on the heels of us having one of our listeners in the office. Haley had given him a shout out last week, Chad C., who was in Texas not too long ago, and said he has personally multiple buildings under conversion right now. So it seems like, Texas may be a little bit ahead of the trend here in terms of the office to residential conversion. And then one other Houston story here. NRG is going to move its Houston office. This is according to the Houston Chronicle. NRG Energy is planning to move its offices to Brookfield's 3 Houston Center, and that'll take place in 2026. They signed a lease for 245,000 square foot at that property on McKinney Street. They're going to be taking 10 floors in the building, and they're currently subleasing more than 400,000 square feet at One Shell Plaza in Houston. Neither of those buildings back any CMBS debt, but a pretty sizable move for a large energy company there in Houston. In fact, at one point they were the namesake or the sponsor of the Houston Texans football stadium. I think they may actually still be.
Yes, I think they still are. That Houston lease, it's such of a piece of so many leases we're seeing right now. It's the ultimate mixed green, right? You love the fact that they're staying in Houston. You love the fact that they're taking nearly 250,000 square feet at the Houston Center. Wonderful news. They're probably paying, a very fair price for that Houston Center lease, but at the same time, they're downsizing from 400,000 square feet elsewhere in Houston. And that's, what we're seeing everywhere, whether it's law firms, accounting firms, oil companies, banks. It's that reduction of somewhere between 30 and 60% of their square footage, which, all in all, just makes more property available, more inventory available in these cities. And, it's good and bad news at the same time.
And I know we're sorry to report these, but we do have some crabgrass stories on the other side of the book.
First one comes from the San Francisco Chronicle. Couple of tough San Francisco office comps coming down the road. This comes from Miss Waxman, who we've quoted many, many times on the San Francisco, one of our Hall of Fame reporters in the commercial real estate space. The 2 that she reported on this week are these. 560-655 Davis Street is going to be acquired by Gaw Capital Partners for $90 million. That would represent $306 a square foot. Why is this such a negative story? Well, Blackstone acquired the asset, ironically, from Gaw in 2018 for $245 million. So this thing is selling for about 40% of what it sold for just 5 years ago. The other comp that is in that article, 600 Townsend Street, LBA Realty is acquiring the asset from Blackstone for $24 million. That would represent just under $300 a square foot LBA had previously owned that property, just as GAW had previously owned the Davis Street property. In the case of LBA, they sold it to Blackstone a couple of years ago for over $50 million. So in this case, a 50% reduction in price for that 600 Townsend Street office. Negative story number 2, this one comes from Columbia, South Carolina. Wells Fargo is laying off 525 people at a single tenant office in Columbia, South Carolina. That particular property backs a $12 million 2015 CMBS loan. The collateral is a 240,000 square foot office at 101 Greystone Boulevard in Columbia. Wells Fargo's lease ends in September 2024. And this is the kind of thing I would have expected to see more stories like this over the last year. Banks have gotten hammered with their share price in 2023. We've seen them become much more cautious in lending. We know that they've been skittish ever since we've seen the SVP deposit run. We know earnings are down. And lastly, we know that the cycle for lending is really, really low right now. That mortgage lending, which is their lifeblood often of these single tenant offices, is anemic right now. 30-year mortgages are close to 8% right now. And in the past, this has meant waves and waves and waves of layoffs in secondary and tertiary markets for single tenant bank offices. In the past, Wachovia, Wells Fargo, B of A, and others, Citibank, have shuttered loan origination and loan servicing offices during times like this. We haven't seen that wave yet in this cycle, but it could be coming. So if you have a portfolio that is heavy on bank tenants, I would be very cautious right now. That is especially with expiring leases, that is a candidate for downsizing through and through.
And our data, Manus, for those office buildings that have a single tenant, bank tenant, there's a lot of additional reserves that are sometimes required on the front end of those just for this reason. So if you go through a lot of our deal documents or data, you'll see it's not uncommon to see a $3, $5, $7 million type of upfront reserve if the building's occupied by a single bank tenant, just for this reason. If they decide that they have to start laying folks off or they close that location down, the building owner needs to be able to re-tenant that space. And so it is interesting. I do think we'll start seeing more potential bad news for those types of locations. I did want to circle back, though, quickly on your San Francisco office comps. You know, we've talked a lot about the retail apocalypse or failed attempt at a retail apocalypse or whatever we want to call it. Have we finally got to the office apocalypse? I mean, like, I know this is San Francisco specific and there's additional external factors, quality of life and other things, but this is probably the third, fourth, maybe fifth podcast in a row where we've had some sort of an office sale at 50% or more in terms of a reduction to its previous purchase price. Like, I think we have to be at that level of apocalypse type of pricing and kind of just where we're at status of the cycle. But wanted to get your thoughts on that.
Well, the first thing I want to do is I want to make sure that we come up with a new acronym for this kind of disaster. The retail apocalypse should live by its own. So maybe we'll go with, let me see, maybe the office annihilation or the office Armageddon. I don't know. Maybe you and I can, what's the word that you copyright that phrase and put it on a t-shirt or something. So if anybody wants to use it in the future, they have to get our authorization for it. I think what you're talking about is a situation of markets finding their bottom. And I think that San Francisco is very, very quickly finding their bottom. What we're learning right now is we've seen now somewhere between 5 and 10 properties sold. The sale seems to consistently be in that $275 to $325 a square foot compared to somewhere between $700 and maybe even $1,100 a square foot 2 or 3 years ago. And this is, what you see, if you've ever seen a plot of land after a wildfire, that, the first signs of regrowth come out of, just little buds of, things sprouting out of the trees that are just lying on the side of the road. And what we're seeing in San Francisco is us starting to see the sprouts coming out. They're not happy sprouts, right? This is not good news. The people that bought these things in 2018 are sitting on tens or hundreds of millions of dollars of equity losses. That's undeniable. But from a bottom where you see people starting to dip their toe, you're starting to see reinvestment, signs of life, votes of confidence, and this is where markets start to rebuild. Unfortunately, I only think there's one or two other markets in the same category. I think it's starting to happen in Baltimore, and that's about it. It happened a long time ago in Detroit. It happened after the oil bust in Houston, but for markets like Chicago, New York, Philadelphia, Los Angeles, I think we're a long way off from seeing those green shoots. So every market will have to find its bottom. San Francisco has found its, I believe. But I think as with the malls, this will take a really, really long time to play out.
I'm hopeful that in most cycles, the sooner you hit bottom, the faster you rebound. I'm a little bit nervous here, though, that it's going to be a prolonged cycle, like you're saying, where just because we've discovered maybe what, rock bottom prices for these assets, the underlying fundamentals, the other systemic problems that are impacting the values have not been dealt with. And so you may see this lower for longer in this example.
I have to go back and look at the data for San Francisco, but some of it may be very unique to San Francisco. And I'm just kind of theorizing here. I don't know this for sure, but in places like New York and Boston and Philadelphia and other places where you weren't seeing that extraordinary tech-driven rent acceleration, you're probably much happier to sign that 10-year lease knowing that you had somebody locked in, right? In San Francisco, my gut tells me that you were thinking, let me lock this guy in for 4 years so that as this market continues to double and triple, I can 1.5x times his rent 4 years from now. I don't want to leave 10 years of rent growth on the table. And this might just be a function of people saying, the end is here now. This lease is going to end in 2025. There's no value here. We're not getting this guy to renew at this point, cut our losses. Whereas in New York, the leases still have 5 or 6 or 7 years to go. This is just a theory, but it may have something to do with the pace at which things are changing hands in the Bay Area.
Manus, I agree with your thesis there. We probably should look through the data because I think we could probably prove out what you're saying. I remember looking at San Francisco, the office market, call it middle of 2020, first part of 2021, and the occupancy was off the charts and the rental rate growth in those markets were just incredible. So I do think that probably is part of the challenge here. I did want to mention we did have a CompStack office piece that we wanted to highlight this week, and so they've released an article recently called "Assessing Office Market Risks and Opportunities." A couple of key takeaways from the research piece. They stated that based on today's leased square footage across major gateway office markets, 2024 and 2025 are the peak years for lease expirations. I think this is kind of interesting because we've talked at length about maturities, 2024 and 2025 kind of being the 2 years with the highest level of maturities, but it looks like 24 and 25 from a lease perspective are going to be the high water marks there. If you parse that down into an individual city, those same 24 and 25 years are also the peak years for lease expirations in New York City's office market, with more than 19% of active leased office space set to roll over during that time period. So about 20% of current New York office leases are set to roll at some point in 2024 or 25. So that'll be an interesting time given where we're at in the office cycle there, looking forward now, maybe 12, 15, 18 months from now. So pretty good story with some really nice takeaways from the office leasing perspective. So you should check it out if you haven't.
And then on another property type, we have some multifamily stories this week.
Very quickly, 4 comps in the apartment segment that we'll run through. A disappointing one in Orlando. This comes from the Orlando Business Journal's Stephen Rzewski. In this particular case, a property at 2333 Lake Deborah Drive was sold by LiveCore, which is part of Blackstone, for a 14% discount to its 2020 price. This is the Harbortown Apartments, which is a 428-unit complex. The property sold for $100 million in 2020, was acquired this week by PLK Communities for $86 million. So a 14% discount. In Huntington Beach, California, according to the Real Deal, Advanced Real Estate Services has acquired 7752 Warner Avenue for $96 million. The sales price for the 264-unit asset equates to $360,000 per unit. Property last sold in 2018 for $90 million. So the new sales price represents a 6% increase over 5 years. The sale includes the assumption of a non-CMBS loan. The seller was True America. In Los Angeles, according to the Real Deal again, Met West on Sunset has sold for 28% below its 2019 price. The property is a 79-unit, 71,000 square foot asset at 5837 West Sunset. The sales price equates to $350,000 per unit, down from $480,000 per apartment in 2019 when the property sold for $38 million. Cypress Real Estate Advisors was the seller. WinStar Properties was the buyer. So what is my takeaway from all this? My takeaway is two or threefold. Number one is we are seeing transactions take place. We haven't ground to a halt. The days of 50 and 75% increases from 2018 to 2023 are long over. The three stories we mentioned, one saw a 6% increase, one saw a 14% decrease, one saw a 26% decrease in values. That is the new normal when new loans are being made at 7 or 8% right now. The last point is, and this is for people that are hoping that the new issuance market will take off again, a lot of these transactions are coming with the assumption of debt. People are taking the 4% loan that they had originated in 2019 and handing it over to the buyer of the property to maintain the debt in place, which, in addition to lowering the cost for the new borrower compared to a new loan, which is useful, it does make these sales prices, Lonnie, a little bit with a grain of salt. You're giving them an asset, you're saving them 3% a year on a loan that may go another 7 years. That does make the sales price a little mushy when you're trying to compare two sales prices across 5 years.
Yeah, all valid points. I think good side of this narrative is that transactions are taking place, which means that bid-ask spread that we talked about for a while is kind of, figuring itself out in the marketplace. Sellers are willing to sell for less or being forced to sell for less, and buyers are finding a price point which they are happy to transact at. And the point you bring up about the assumable debt, at the conference I was at today, they had a broker panel, and this was definitely a topic of discussion for them. If you have fixed rate assumable debt, it definitely increases the likelihood of you getting a transaction done. And to your point, from an appraisal perspective, one of the adjustments in the sales process is to look at the financing terms. So if something is being assumed at 300 basis points less than prevailing interest rates, you have to make an adjustment to the sales price to use that as a valid sales price comp, because that's more favorable than what a typical buyer could get at the marketplace. So I do think you're going to see an increase in activity on the assumable debt side of the house. And to your point, those are probably going to be slightly inflated prices given the upside on saving the interest over whatever remaining term is left on those deals.
I do want to close with one very happy multifamily story. This comes from Vista, California. A press release from MG Properties Group announced that it has acquired the Waterleaf Apartments in Vista, CA for $174 million. Vista is a suburb of San Diego. The sale would represent the second highest price paid for a San Diego MSA apartment complex in 2023. The property is a 456 unit asset. It equates to almost 300 or a little more than 380,000 per unit. Why is this one a happy story? The property was last sold for $117 million in 2017. In this case, the sales price does represent a big premium to that last sale price, a 48% increase from the 2017 value. Again, in this case, a loan assumption was part of that deal. So wanted to close out with at least one really positive comp for the multifamily market.
And lastly, because we are trying not to end a podcast anymore without talking about industrial, we do have one story for that segment this week.
Yes, I like this story. It's a little bit different. Long Point Realty Partners has purchased the John Reed Commerce Center in the City of Industry in California. They paid $80 million for the asset, which totals 275,000 square feet. The sale equates to almost $300 a square foot. The story comes from The Real Deal, Isabella Farr, who's just been on fire in terms of covering the CRE market. So many stories from her every week. Really a pleasure to read her reporting. Why did this one catch my eye, Lonnie? I'll tell you why. This particular sale, $300 a square foot, that is not that unusual in this particular market. We've seen Amazon tenanted and other big distribution centers sell for $300 a square foot. This is not a unicorn in that regard. However, in this particular case, we were talking about 12 warehouses, each one being about 25,000 square feet. So this is a case where you weren't talking about Amazon-sized assets. This was small warehouses, probably sold to small tenants in bite-sized increments. Not the kind of thing we've been seeing $300 a square foot for so far. This has been the kind of thing, 120, 150, 180. To see this get $300 a square foot is a real green shoot, I think, for a market that we've wondered, when is it going to run out of steam?
Yeah, I think it's an interesting takeaway. At that size per building, you're probably not talking about a bunch of credit-worthy tenants. And to get that type of a price, it's kind of jumps off the page at me. I mean, like, I'm a little old school, I guess. Like, I have a hard time fathoming this $300 square foot industrial market that we're in right now. Kind of like I had a hard time understanding 1960s and 70s vintage multifamily trading on a 4 cap rate for the last 2 years before the cycle started to deflate a little bit. So great news for the seller of this asset. If this persists across this type of warehouse across the U.S., I think we're in for some interesting discussions, because this used to be Class A office type of price per square foot. Now we're getting it for 25,000 square foot warehouses with, a little bit of a economy of scale component with 12 buildings. So great for them. And maybe I just got to get off my lawn chair and quit watering the lawn and accept that's what the market is.
Okay, and we have some shout outs this week from some of our loyal listeners and some new listeners. Brad C. reached out and congratulated us on a great interview and podcast with Ethan Penner, and he also said he pre-ordered the book. So thank you, Brad, for listening and letting us know. Chad C., who we already mentioned, he sent us a office crabgrass story. Steve K. said him and his company are avid listeners of the podcast and they tune in every week. Brian Yu is a huge fan of the podcast and tunes in for every episode. He sent us a Real Deal article discussing multifamily coaches and gurus and the role they've played in the run-up in multifamily valuations and the ongoing debt maturity crisis. So we might need to get you guys to look into that one and touch on that next week. Then on Twitter, we had a lot of people reach out. Varun R. highly recommended listening to last week's podcast episode. He said a lot has happened over the last few days, from treasury rates hitting a 10-year high to the U.S. government avoiding a shutdown. So thank you for giving us that shout out. Jason C. recommended the TreppWire podcast to a new associate. He also said that, Lonnie, you are the Pat McAfee of CRE.
I know this is, audio only, but for our audience out there, Lonnie has really embraced this. He's gone with that black tank top, sleeveless shirt. He likes to show the guns off, and he's really gone full Pat McAfee. We someday have to put that visual together on our website, I got to say.
Yeah, when I saw this, I was thinking like maybe Haley forgot to edit out all those F words that me and Manis drop on the unedited version of the pod, and I got to work on the tan though. I mean, I got the sun's out, guns out, but my arms are looking a little pasty compared to Pat McAfee's.
I do have a shout out, Mark M. in Las Vegas. He sent me a green shoot, which we didn't get to today, but we'll try to remember to get to that next week. And I do want to say that every week we go through, 15 stories, Lonnie and Haley, something like that, property type stories. We could go through 50. We could go through 100. There's so much activity out there. And this is our way of saying sometime in the next 6 weeks, we are going to be launching a new offering, a new newsletter, which will come out daily, which will give you the insights into everything that we are talking about every day. We're excited to put it out there. Look for more coming from the Trepp marketing team in the coming weeks. Really excited to do it. But we think in these interesting times, there's so much to talk about. And we hope to bring the same energy and look and feel to that daily 7 a.m. newsletter that we're coming out with in November that we do to the podcast every Thursday night. So look forward to that coming out.
Yes, send us an email to podcast@trepp.com if you'd like to learn more about that, or you want to be one of the first people to find out when that's ready. And while we have you, if you haven't rated us or reviewed us on Spotify or Apple Podcasts or whatever your preferred podcast provider is, please give us a rating and a comment. We would sincerely appreciate that. And a few more here. Jack H. also told us he pre-ordered his copy of Ethan Penner's book after listening to the podcast. And Shlomo C., we gave you a shout out last week, and he said his day is made, and he had some suggestions for what he needs from us. So I think, Manis, you have something you owe Shlomo next time you see him. Ben P. said he got to tune in to this week's podcast. He said it's a slow trot out there and exactly what the Fed wants with its lagging effects of interest rates. He had some additional commentary for us, so thank you for listening.
It's good to see our friend Ben P getting back into the Twitterverse with the TreppWire. We missed some of his commentary. He had been an active listener and Twitter follower, and then I think he had gotten on an NVIDIA binge over the last couple of months. So good to see we've reeled him back in, and hope he's doing well out there in California.
And I think, Lonnie, you got a few requests for people wanting to see you all across the country after you threw out that plea last week. But I want to say, Lonnie's usually only in these states for one day, so I'm not sure how he'll fit everyone in, but I hope he can.
And if I haven't responded to you yet, I will get a DM or an email back to you. And to Haley's point, these are usually quick trips, but I'm going to do my part to make sure we get a few hours, maybe get a drink, grab some lunch, do something. So appreciate the response, and look forward to meeting with those of you that have reached out.
And with that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment, send an email to podcast@trepp.com and subscribe to the TreppWire podcast with your favorite provider. Thank you for listening, and stay well.
All right.